What better thing to talk about right now than the broader market, because the Dow, the S&P, the NASDAQ, the Russell 2000, they have all been on record runs. The Dow up now the 14% year to date. Let's figure out where things may be going from here. Dennis Davitt and Matt Maley are your guests today. And Dennis, you're the volatility guy, you're sort of the options guy, the protection guy. The market's been great for the not the average investor, but somebody a little more sophisticated. Is it smart right now to buy some protection? And if so, how would you best do it?
I would definitely buy protection right now. I mean, as we're speaking, Dow could be breaking through 20,000. The reason I say you should buy protection, and we're on the web so we can get a little wonky, the demand for calls has driven down the demand for puts to like a 5-year low. So basically what that means is insurance is approaching a 5-year low. We have a Fed meeting tomorrow with what could be an overheated economy. So we have Fed raising rates, markets at all-time highs, a new administration, and the cost of buying insurance on your portfolio, on your broad portfolio, be it Dow Jones via Diamond puts or S&P 500 via Spider puts, has never been cheaper. So I think it's really prudent right now, if you were lucky enough to participate in this rally, or even if you want to put money to work right now, buying an insurance package against your investment should be mandatory.
And how would they do it? Or just give us a simple strategy.
I would go out and buy what would say is a 30 delta put. So if the Dow 20,000, so the diamonds, that would be 200 on the strike. I would go out and I would buy the 190 put. I'd buy the 190 put expiring in February, and that will protect you to the downside of the market. If we do really roll over,
and it won't bankrupt you if the markets keep going up.
It's never been cheaper. It's not free, but it's never been cheaper than it is right now.
All right, we got auto insurance, home insurance, now a little market insurance. Matt Maley, looking at the S&P 500 or the Dow, whatever you want to look at. I mean, nobody looks at the Dow. The S&P 500, do new highs generally beget new highs? What's the risk level here?
Well, they do tend to, especially when you break out from a previous high, like we did just a week or two ago. The thing that we do have to worry about, though, is that we're coming right up against a resistance line. If you look at going all the way back to the highs in 2007, if you draw a line along the top of those highs, where basically it comes in at 2275 in the S&P, which is basically where we are. Now, it can always get a little bit above that, but the market's overbought on a short-term basis. The problem is that that line that I just mentioned is the upper line of what you would call is a rising wedge formation, and that's usually a bearish formation. So if we fail to break above that, as Dennis said, we could have a sharp pullback all the way down to the bottom end of that line, which is well down near 2,000, actually at about 2050 on the S&P. And if you break below that, then you got real problems. So I totally agree with what Dennis is saying with the options being so cheap. It's a good time to put a little insurance in your pocket right now.
Okay, put a little insurance, both from Dennis and Matt. Good recommendations, gentlemen. Thank you both very much. Been interesting times. Thank you. Folks, thank you for tuning into Trading Nation. I'm Brian Sullivan, and we will see you next time.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.